How you doing? I'm Big D. Welcome to the show. What I want to talk about today is how physical demand explodes and it can benefit you and your family un- with a crazy amount of money in your pocket. And it could start as early as right now. If you look at what happened, let's just talk about silver for a minute and what happened to them with silver itself in supply versus demand. You have something that's not a correction, that's not a noise. This is not some algorithm bouncing off a technical level. This is silver that has a huge demand. They cannot meet the demand at this present time. It used to be 3 days, and you could see your product going out of the warehouse and on the way to you. Now it's several weeks. And notices are going out from bullion dealers saying exactly that. Sorry for the delay, but it could be several weeks longer. Do you want to be that guy? Well, maybe finding some silver locally, maybe a pawn shop, maybe a local coin shop. It might be something you might want to look into. But let's talk about why. Now, this is not some algorithm bouncing off a technical level. That's a structural shift in how serious money is behaving. And if you're still focused on what some talking head on the financial television is telling you, some media coverage on CNN, MSNBC, ABC, CBS, whatever it is, you're already behind the eight ball. But before we go any further, hit the subscribe button. I definitely need your help. I'm trying to build the channel. Hit the like button. Leave a comment in the comment section. I'll leave a comment for you, and I will definitely would like to know where you're from. That would be great if you wouldn't mind sharing. Now, what I'm about to talk to you about and walk you through is going to completely change how you think about the next 18 months, because I believe that's going to be the timeline. Don't quote me on it. See my description in my disclaimer in the description below. Here's the thing that separates people who build real wealth from people who stay broke their entire lives. The broke people watch price. The rich people watch flows. The broke people trade paper, fake paper silver if we're talking about silver. The rich people own things, meaning physical silver. Again, if we're talking about silver. And right now, there's a massive divergence happening between what people think the market is doing and what the market is actually doing. And it all comes down to physical demand. Let me be clear what that means. Physical demand explodes. I'm not talking about some chart on Bloomberg terminal moving up and down. I'm not talking about future contracts or options, positions, or any of that synthetic nonsense that most retail traders are obsessed with. I'm talking about real demand for real things, real inventory moving from one place to another, real buyers stepping up and saying, I want to own this and I'm willing to pay for it today. Now, this is fundamentally different from someone speculating on what something might that have maybe happen tomorrow. Now, the average person thinks markets are news. They're actual truth. That markets move on the news. Now, that's actually backwards. Markets move on position. News is just a moment where, or when everyone who didn't understand positioning finally figures out what happened. By then, the real money is already someplace else, already positioned, already moved on to the next inefficiency. And what we're seeing right now is physical markets and the real money is repositioning. And they're doing it quietly away from the noise of social media, Reddit, financial TV. Think about logically for a second. If you're a major institution, if you're sitting on billions of dollars and you want to shift your exposure from paper assets into real tangible ownership of something scarce like silver. Now, do you do it on CNBC announcing your moves? Would you do that if you were a major company, major player in the game of silver? Do you send out a press release? Of course not. You move quietly, you accumulate. They don't tell their secrets, so how do they make money? But you build your position through multiple channels, multiple counterparties, multiple geographies. And by the time the public even knows you're buying, you're already ahead of the curve, already projected, already positioned for what comes next. Now, that's exactly what happened right now. With this surge in physical demand, institutions have already done their homework. Now, they've already analyzed supply constraints, they've already game theorized what happens when certain assets become harder to find, and they're already started moving. The physical demand exploded. Um, isn't the beginning of this move either. It's the visible proof that the move is already well underway. Now, here's where most people get this completely wrong. They see a move in physical demand and they think it's going to translate into something immediate or like an immediate spike in price. That's not how this works. Physical demand tightens supply. So, tightening supply creates a foundation. The foundation builds slowly at first, invisible to most of the market. But then, once enough players recognize that the supply side is genuinely constrained, once they understand their ownership is becoming more valuable than speculation, once real yield and real assets start attracting serious capital, that's when prices follow. And when it follows, it doesn't follow slowly. Let me give you the honest version of how markets actually work. There's a reason why the richest people in the world own real assets. It isn't because they're sentimental. It's not because they like the idea of ownership. It's because real assets have something that paper never will. They have scarcity, they have unity. Let me give you a little detail about the amount of paper silver versus one physical silver. There's probably over 300 to 400. There's so many reports that come out of fake paper silver. 3 to 400 ounces of that out on the market and that has already been sold versus one physical silver. So you can see how they manipulate the market. They have people who need them. So, and when scarcity combines with the need, price doesn't go up because of sentiment. It goes up because supply generally cannot meet demand without moving higher. The difference between physical ownership and paper speculation is this. When you own physical money, physical silver, I mean, you own the actual thing. You own the risk, yes, but you also own the upside, the shorts. When you speculate on paper, you're making a bet on what someone else will pay for it later. You're not owning the upside. You're renting a view of it, so to speak. And during times of market stress, during times of genuine economic uncertainty, renters get liquidated. Owners, owners stay. Owners hold. The old sentiment goes, you don't hold it, you don't own it. You have to own it. You have to have it in your possession. Now, owners benefit when scarcity finally gets priced into the market. Now, if this is already changing, then you have to think about real assets. Don't forget to subscribe now because the most important part is still ahead. When we're actually seeing right now is a massive shift in risk perception. Over the past several years, a lot of institutional capital moved into financial assets. They moved into bonds. They moved into equities. They moved into derivative positions that promise higher returns. But underneath all of that, beneath the surface, that CNBC, etc., you can name your tune when it comes to CNBC, CNS, CNN, whatever you want to call them, is obsessing over every single day. Something shifted. People started asking different questions. People started thinking about tail risks. People started wondering what happens if things go wrong. People start positioning accordingly. And positioning in a world of uncertainty looks different than positioning in a world of confidence. In confidence, you own paper, you own leverage, you own complexity. In uncertainty, you own real stuff. You own physical. You own things that have been valuable for 500 years and will be valuable for another 500 years. You own things that can hold and you can touch it and you understand when you have it in your hand. So the 250% surge in physical demand reflects all of this thinking, crystallizing into action. It reflects institutions, high net worth players, sophisticated investors who have spent years analyzing supply chain and geopolitical and monetary policy, finally saying, okay, we're done analyzing. We're moving. And when serious money moves, prices follow. But prices follow last. Physical flows move first. Price is a lagging uh, indicator of what the smart money already knows. Here's what the most investors in it that do in a moment like this. And I want to be very direct with you because I've seen this pattern thousands of times. Well, probably not thousands. I make it sound like I've been doing this forever, but now most investors focus on short-term movements. They look at a chart, they see something moving up, they feel the FOMO, they get in, they feel down about it. Within 3 months, they get out. And then they tell themselves what the whole thing was a hype. Meanwhile, the actual structural move is still happening. It's still playing out. It's still making money for the people who understand it. Most investors ignore physical market data because it's not as visible, not as exciting, not as easy to digest as a price chart. It's harder to get it. It requires more analyzing. It requires separate real data from noise. So instead, most investors just chase what's easy. They chase price. They chase momentum. They chase whatever's on their phone screen. Now, when those things fail, they panic. They sell into weakness. They miss the real move. Disciplined investors think differently. Disciplined investors watch flows. They study supply reports. They understand geopolitical and geopolitics. They separate market noise with actual signals. They care more about whether demand in generally strong, stronger than whether price happening to go up 3%, like yesterday. To care more about whether supply is generally tight than whether some news stories move the dial for an hour and then move it away. Here's the critical difference between someone who builds lasting wealth and someone who stays stuck on in the cycle of financial frustration. Wealth builders position early. They position patiently. They understand what the most profitable trades are, the ones that look boring for months before they become obvious. Now, the trades that make money are the trades where you are positioned where nobody cares. When everybody is distracted, when the narrative hasn't changed yet, and then you hold while everyone else is catching up. or has sold. And by the time everyone is finally paying attention, you're already up significantly. Now, that's the playbook. That's always been the playbook. That's how serious money operates. The bounce back that we're seeing right now is not hype. It's not manufactured. It's not some algorithm spike that's going to reverse it in 3 months. It's real because it's built on real demand and real constraints. Physical demand, despite doesn't spike 250% on speculation. It spikes because something genuine is shifting. It spikes because real supply is generally constrained. It spikes because people who have to own something are willing to bid up to get it. And when that kind of demand is genuine, when it's driven by real need and real scarcity, price follows. It doesn't follow immediately, it doesn't follow smoothly, but it follows. And the people who understood the demand shift before price started moving, those are the people who make money. Those are the people who look back in 12 months or 24 months and say, I am so glad I paid the attention that to the signal. I'm so glad I positioned when everyone else was distracted. Think about the timeline here. Where is a we're we're in a moment of genuine geopolitical uncertainty. We are in a moment where supply chains are fragile and contested. We're in a moment also where people are questioning whether financial assets are worth what they're supposed to be. In the environment, real assets become more valuable. Real ownership becomes more attractive. And when serious capital shifts from financial assets into real assets, physical demand goes up, supply gets tighter, eventually price reflects that reality. Most people will only figure this out once it's already obvious. They'll wait until physical demand is no longer surging. They'll wait until price has already moved significantly. They'll wait until the narrative has changed and every financial news outlet is talking about it. And then they'll try to get in, and they'll get in at a much worse price than if they had just paid attention to the signals that were visible right now. That's that's not a knock on them. That's just how the markets are and how people are. Markets always reward people who see the signal before becomes noise. Markets always punish the people who wait until the signal is impossible to miss. Because by the time something is impossible to miss, you're at the expensive end of the move, and not the cheap end. This is about something cheaper than just price prediction. This is about understanding how capital actually moves. Now, this is about understanding that the market is not random. Markets are not unpredictable. Markets are not run by luck. Markets are run by incentives. Markets are run by capital flows. They're also run by people trying to position themselves ahead of what they think is coming next. Now, people who know how capital flows are positioning themselves for higher scarcity and higher value in physical assets. The bounce back is real because it's not a bounce, it's a repositioning, it's a structural shift in how capitals allocate. The structural shift don't reverse quickly. They don't reverse on some bad news or some market panic. They persist until they're fully priced in. And until everyone understands that, they're fully priced in. There's money to be made to be understanding them first. I want to I want you to think about this from first principle. What creates substantial price increase? Not sentiment, not retailer trade or social media. Sustained price increase comes from real supply and demand imbalance. They come from situations where buyers generally need something and sellers don't have enough of. Now, if in the environment price goes up because it has to go up to be clear and clear the market, it's not emotional; it's mechanical. What we're seeing is physical demand is exactly what setup. It's exactly the setup where buyers are stepping up and saying, "We need this. We're willing to pay for it. We're willing to wait in a long line." When enough capital thinks like that, when enough serious money thinks like that, supply cannot keep up. And when supply cannot keep up, price adjusts. Now that's not prediction, that's logic. And here's what separates people who understand markets from people who don't. People who understand markets know that price is temporary, positioning is permanent. You might miss a move by a few percent. You might get the timing wrong by a few months. But if you understand the structural shift that's happening, if you understand the capital flows for one place to another, and if you understand the scarcity is tightening somewhere, then you're positioned for the long term move. You're not trying to catch every single penny in between. You're trying to be on the right side of the structural shift. And right now, the structural shift is that capital is moving from financial speculation into real ownership. And that shift is real. That shift is happening. The shift is visible in physical demand numbers. And that shift will persist because the underlying logic hasn't changed. Uncertainty drives capital towards real assets. Scarcity drives prices up. Long term ownership benefits. The people who are going to do well over the next couple of years are the people who position themselves on the right side of that shift. Now, the people who trade it, not the people who try to catch every move, not the people who chase price, um, the people who are going to do well are the ones who understand that physical demand exploding in a single of a structural change and they position accordingly. And it's just amazing of what is going on right now. And if you watch the next show of today, you're going to find out a real reason why Friday happened. Friday happened because of 50 countries that got together with the United States. You got to see that show. You got to see it to understand what I'm talking about today. So try to have a great rest of your day. Silver is going to break out. I do believe it 159,000%. Have a great rest of your day. God bless.